Good morning, ladies and gentlemen, and welcome to the OPG Power Ventures PLC investor presentation for the final results for the year ended 31st of March 2021. Throughout this presentation, investors are in listen-only mode. Questions are encouraged and can be submitted anytime via the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, scroll to the bottom and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Arvind Gupta, Chairman, Dmitry Tesvatkov, CFO. Good morning. Dmitry, the floor is yours, sir.
Good morning, ladies and gentlemen. Good morning, our shareholders, investors, advisors, and other stakeholders. Today, Arvind and I would be happy to present our FY21 results. And our presentation is available on our website, but you can also see it on the screen if you entered the Investor Meet platform, which was provided to us very kindly for presenting our results. So the theme of our today's presentation is FY21 results and continued focus on deleveraging and profitability and positioning for sustainable growth. Second slide, please. On the second slide, you can see our usual disclaimers, which are required to be provided to investors. Moving on to slide 3. You can see that our company is a developer and operator of power plants in India, and our flagship plants are located in southern India, in Tamil Nadu, and the total capacity is 414 megawatts. We also have 4 solar plants located in another southern state, Karnataka, with total capacity of 62 megawatts, where the company holds 31% equity interest. As of 1st of October, our market capitalization was just a little bit above 50 million, and we had around 400 million shares issued. Please move to slide 4. On slide 4, we present a snapshot of our positioning and our key highlights of the business and operations. First of all, it would be worthwhile to mention that the company is positioning extremely well on the fast-growing electricity market in India, and it is underpinned by growth of GDP in India over the last number of years in the tune of 7-8%, and related increase in demand for power. The company managed to reduce debt significantly in line with our deleveraging strategy, and at the end of March 31st, 2021, our gross debt was at 46.6 million, a reduction from 56.8 million last year. We also had our gearing ratio at 9% and net debt to adjusted EBITDA of 0.5. There are no term loan repayments till June 2022 due to the refinancing with non-convertible debentures achieved June in 2020. And the company is scheduled to be debt-free in Chennai by financial year 2025. The company has a significant potential in terms of delivering shareholders' value. We pay dividends from FY17 to FY19. We have track record of paying cash dividends and scrip dividends, but the dividend policy on a going forward basis will be revisited by the board after the situation normalizes, given the COVID restrictions which are still operating effective in India, and also a reduction, increase in coal prices and the freight happening this year. We also have a significant potential for further ESG-focused growth, and we have strong EBITDA and profitability margins which differentiate us from the market. Moving on to slide 5. For those investors who are new to us, I would like to mention that we have a diversified portfolio of industrial and commercial captive power clients, and they're represented by variety of industries, including textile, automobile, paper, chemicals, and we have a very robust tariff policy on the multi-year contracts and a good cash cycle with credit-worthy customers. Moving on to slide 6 and slide 7. We would like to show on slide 7 our key financial highlights. Our FY21 generation was 2.1 terawatt hours, down from 2.7 terawatt hours last year due to the restrictions, COVID-related restrictions, and the decline in power for demand for power. Our tariff was on average around 5.5 rupees per kilowatt hour, which is around 5.5 pence in GBP terms. Our revenue decreased from 154 million to just under 94 million this year due to COVID-related impact. However, our bottom line and EBITDA and profit before tax actually increased, and our EBITDA increased to 33.7 million, which is an increase of 2.5 million on last year. Adjusted EBITDA margin was 36%, and our profit before tax increased from 14.5 million to 21.6 million. And those commendable results we achieved due to the receipt of historical claims payments in the tune of 9.4 million during last year. As I mentioned at the previous slides, our deleveraging strategy produced a very robust balance sheet with gearing ratio of 9%, and we had 8.2 million term loan principal repayments during the year, with accretion to shareholder per share of around 2 pence. If you can move on to slide 8, we would like to present here a new analysis demonstrating the free cash flows of OPG versus free cash flows and free cash flows yield of Indian and European peers. You can see here that our cash flows for operations this year were around 40.2 million, and on average over the last 3 years, that was 32.5 million. And free cash flows, which is cash flows for operations minus capex minus net finance costs, were around 34.7 million in FY21 and 22.6 million over the last 3 years, which translates into free cash dividend yield based on the market cap of 51 million at around 67% this year and 43% over the last 3 years. If you look at the tables presented on this slide, listing our peers in Indian power sector and European companies, you will be able to see that we have average for Indian peers of free cash flow yield just under 5% and exactly 5% for European power generation companies. Also, our price to book ratio for OPG is just 0.3 versus 1.2 for Indian peer companies and 2.3 for European companies. These numbers can demonstrate that the company has currently significant discount to the fundamental value, and based on any metrics, our share price is trading at around 75 to 80% discount to fundamental value, and company is working diligently on reducing this discount over time. Going on to slide 9. Here we are presenting performance of the company over the last 5 years in terms of generation and planned load factor. And as you can see that in pre-COVID times, our planned load factor was in excess of 75%. Current year, FY21, it was 58% due to reductions in demand for power relating to COVID disruptions. And our generation in million units was always in excess of 2.5 terawatt hours, with 2.1 in the current year. What is worth to mention that subsequent to the year end, the demand for power increased in India, and we had average PLF of 73% in the period to August 2021. However, the further recovery of generation will be subject to dynamics with coal prices and freight. Slide 10, please. On slide 10, we present an announcement effectively of our first ever standalone ESG report, which is available on our website. And it is a very comprehensive and large document with more than 30 pages, presenting OPG's performance on all three letters of ESG. We are focusing on providing data not just on emissions, not just the CO2 emissions, but also use of intellectual, physical, natural capital, social capital, and relationship of OPG with local communities, and also our support of local communities in terms of during the COVID-19 period. We also demonstrate our usage of various resources, including water and waste disposal policies. And we believe that our first ever standalone ESG report provides strong foundation for investors and stakeholders to assess companies' performance on ESG agenda, and also to benchmark us on improvement on key ESG targets over medium and long term. So I would encourage everyone, all our stakeholders, to read this report very carefully because we believe that this is the first time ever we've provided so much detailed, specific information which will help to assess sustainable long-term performance of the company. Moving on to slide 12, which is FY21 results, key performance highlights. I would like to summarize here all the key financial indicators. As we previously talked, the revenue decreased by 39% to £94 million, but adjusted EBITDA actually increased by around 8.2% to 33.7 million, and profit before tax increased by 49% to 21.6 million, and profit after tax for the year was 14.1 million, an increase of 75.6%. We comfortably met our market expectations with respect and projections with respect to our income statement parameters, but we significantly exceeded market expectations in terms of deleveraging. And our net debt at the end of March was around 16.2 million, with net debt to adjusted EBITDA of 0.5. And this is a significant reduction from last year, and it compares with 25 million net debt, which was projected in market expectations. Moving on to next slide, slide 13. Here we have just again description of all the key financial parameters which I presented at the earlier slide. But also I would like to mention that post year end in June 2021, the board of OPG created a separate ESG committee, which was headed by Mr. Michael Grasby, and we've issued our first ever standalone report, and we'll continue building on strategy under the guidance of ESG board committee. Moving on to slide 14, again here it would be important to show in perspective the performance of the company over the last several years. You can see that revenue in pre-COVID times was consistently above 140 million and up to 154 million in FY20. Adjusted EBITDA, even in pre-COVID times, was always above 30 million pounds, reaching 35 million in FY18 and FY19. And the profit before tax was consistently increasing over the last several years with 21.6 million in FY21. Next slide is 15, and it shows how OPG delivered on our deleveraging strategy over the last several years. 3 years ago, the board announced that we are focusing on deleveraging and paying down expensive Indian debt with Indian banks, and we consistently managed to achieve it with gross debt being 46.6 million at the end of March 2021, and gearing ratio being 9%, one of the lowest in the industry, and net debt to adjusted EBITDA decreasing from 1.7 to 0.5 times. And now we would like to move to Outlook section, which is slide 16 and slide 17 following this. We operate in the environment which is unprecedentedly volatile in terms of coal prices, freight, and other commodities, as you can probably see from the news coming to us every day. We consume coal for generation of power, and on this slide we present historical index of our 4200 Garth-Valarific Indonesian coal, which spiked over the last 6 months immensely. It actually increased 3 times. And the same happened with freight, which also increased almost 200%. This is a period of unprecedented volatility caused by geopolitical tensions between China and Australia. This is how it started. China basically banned supply of coal from Australia, and they switched to supply of coal from Indonesia. And then the robust recovery post-COVID in China and other Southeast Asian countries caused increased demand for coal. This caught everyone, including ourselves, it caught us by surprise in many respects, because in medium and longer term, the company and the whole world is expecting that the world will be becoming cleaner and greener, and the consumption of coal would be reduced. But in short term, we definitely see a lot of volatility happening. However, if you look at the table on the slide with average 8, 10, and number of other years costs of index price, you can see that in medium term, we expect that the cost of coal should normalize and return to the range between $30 and $40. In terms of our priorities this year, if you can move to slide 18, again, we are focusing on maximizing cash flows from existing operations by superior operational performance, and we managed to increase PLF in the first 5 months of FY22 to 73%. However, this will be all subject to coal and freight prices dynamics. We have a certain portion of our coal needs hedged under the fixed price contract, so we have protection from full market exposure. However, there is a significant portion of our coal needs and freight which are unhedged, and therefore our results are subject to volatility in commodity prices. However, we expect that while in short term the coal price and freight are expected to remain on a high level, in medium term and longer term they should normalize and revert to what we've seen in historical numbers. In terms of safety and environmental performance, we adhere to the best industry standards, and we fully comply with all the regulations. We put ESG agenda at the top of our board discussions and activities of the companies, and health and safety is also quite critical for us, and we have near zero recordable incident rates, which is a very robust performance in terms of safety and ESG versus our peers. And in terms of focus on return to shareholders and the deleverage, we delivered consistent repayment of our debt. We plan to continue conserving cash for repayment of debt and growth-related ESG projects. And the board will revisit the dividend policy when situation with COVID-19 and coal and freight prices normalizes. Now, moving on to the slide 19 and following slide 20, we would like here just to talk about strong fundamentals in Indian economy and COVID-19 impact. Currently, Indian economy, which was affected very harshly by particularly second lockdown, is showing signs of bouncing back, and economic growth is expected in the tune of 8 to 9% this year, which is financial year 22, albeit on a lower base. India faced a lot of increases in infections, particularly in the middle of May. It reached the peaks, but following that, the program of vaccinations delivered very positive results, and now we have a significant portion of population, around 0.75 billion doses, being administered, and 8 million doses being administered daily. What we can clearly see that the state governments are now unlocking and easing restrictions, and it's done in a very focused and phases way. On 1st of April 2021, the deadline for meeting emission norms for majority of coal-based plants was extended, and for us, the deadline moved to December 2024. Therefore, it gives us more time and more cushion in terms of preparing for these additional projects to reduce emissions and to meet new expectations. And in terms of power sector, we can see a clear recovery of demand for power, which is linked to the growth in GDP, which is something which is expected to be in tune of 8-9% this year. Moving on to slide 21. Here we just summarize the key drivers for power demand in India in long term. The country is required to have a lot of infrastructure developments, and Indian government is focusing on development of smart cities and various schemes to support urbanization and Make in India initiatives. And the government is also pushing on electric mobility and to strengthen the energy transition in the country to meet the climate Paris Agreement and to address those risks. And this is the end of the formal part of the presentation. On slide 22, you can see how to contact us. If you have specific questions, we will be happy to answer them. And this presentation is available on the website and will be available after the recording of this webinar. And now I would like to open the floor to the questions.
Fantastic. Dimitri, thank you very much indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the top right-hand corner of the screen. But just while the team take a few moments to review those investor questions submitted already, I'd like to remind you that recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via the investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company. Immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Dimitri, Arvind, before we go into some of the live questions, we did receive several pre-submitted questions. If I may, I'll just open the floor with those. The first one reads as follows. Can you please comment on how you plan to allocate capital when the debt is paid down?
Thank you for this question. Our focus for this year is to manage the volatility in commodity and freight prices. So even though we achieved very enviable and robust balance sheet position in terms of deleveraging, we believe that this year is going to be the year which we require to be very cautious and cash conservative. But we are assessing another opportunities for responsible ESG focused growth to meet the ESG strategy objectives, but also to reduce our carbon footprint. Also, this will provide an opportunity for the company to return to the growth stage not immediately, but at the later in medium and longer term. So following the return to the normal situation with COVID and with commodity prices, we are planning to, first of all, be very responsible in terms of continuing responsible growth, and also revisiting our dividend policy to meet the expectations of our shareholders to deliver the return in the form of dividends, but also in form of growth, capitalizing on opportunities available on the Indian market. If Arvind has anything else to add, we can put it open for the mic from Arvind as well.
No, nothing to add in this.
Okay, the second question we had along was, how long do you expect to run the coal plant? I.e., what's your assessment on decarbonising pressures hindering the continuation of the business?
We expect that the coal-fired power generation industry will be there for decades in India to stay. Even though Indian government has very ambitious targets with renewables and building capacity with renewable energy, the share of thermal power is going to stay at around 60% by 2030, judging by the latest forecast by experts. Indian economy is expected to continue growing in the tune of 7-8% on annual basis, and demand for power will be growing in line with this GDP increase, and therefore there will be a long life for thermal power plants, and particularly for our plant, which has been built. The first unit of our Chennai plant was built just 10 years ago, so we have another 30-40 years of operations of our plant, and we have a lot of good things to say about, I think, technical parameters of our plant, including flexibility in boilers. We can blend different type of coals and manage our production if there is some volatility in commodity prices. Also, our plant is located very close to the port, and we have access to international sources of coal and also domestic Indian coal.
I would like to add here, India, as a signatory of the Paris Convention, has clearly stated that it will continue to build even new thermal plants. If you look at the convention details, there are about more than 1,000 new plants which will be built between India, China, and some of the other Asian countries. What will happen in India is this growth of power of 6-7%, which is happening every year, that would be met by the new additional renewable capacity. So we don't foresee any of the existing plants, other than the plants which have run out of their life, to face any major difficulty.
That's fantastic. Thank you very much, Arvind. Thank you, Dimitri. If we just move on to some of the live questions here, we've had a number of questions just around hedging. How much of your coal is hedged? Can you use local coal to limit sea freight costs? Could you just give a little bit of further colour on that for the attendees, please?
Yeah, I will give you an update on that. Currently, for the current year, we had approximately 20% of our coal hedged at a fixed price. And the balance coal is all covered, but it is all at the prevailing international prices. So the quantity is confirmed, but the pricing is not confirmed. Pricing is volatile depending on the market conditions. To overcome this, we had purchased some Australian coal at lower prices. Plus now we are getting some Indian coal, which is also at a much lower price.
That's fantastic. Thank you very much indeed. Next one we've got here is, can you increase your prices to offset the increased cost of coal and freight?
We are running in a regulated market in India. Unlike the Western world, if you look at in many parts of Europe, in the last 3 months, the power prices have gone up by 2 to 3 times. Whereas in India, we have had situations where there has been a tremendous power shortage of even up to 50% or 60%. But the tariff does not change because the tariff is a regulated tariff and it changes only when the regulator changes.
And
So
just touching on that, sorry, Arvin, there's another question we've got in here saying there's an article in the FT today that many of Indian coal plants only have 3 days of coal supply available due to the coal pricing situation. In light of this, is there going to be potentially that opportunity for a temporary price rise? Obviously, it's
no,
structural.
no. What will happen is there will be a temporary price rise on the short-term market. In India, there is a power exchange where they had power is traded. But if you look at the volume that is traded there, it's only 4% of the power. So those market prices will go up. Already they have gone up by nearly 100%. They would follow like the European market, they would go up by 3 times. But the price being paid by the consumer, by the householder, by the small industries, large industries may end up buying slightly higher price.
Fantastic. And just another extension of that question here. It seems that India's coal inventory is running low. How has this affected you?
It does not affect us because currently we are not using an Indian coal. Only now we have bought some Indian coal in the auction, which will get delivered to us only by December. So the present crisis, what we are reading in the press is relating to certain power plants which are near to the mines and they are having some issues where their inventories have come down.
Fantastic. That's great. Next one we've got here is how's the progress on the renewable assets going?
The assets which we have in our balance sheet relating to 62 megawatt solar projects is classified as asset held for sale, and we run this process, but obviously last 18 months it was impeded by the COVID-19 related restrictions. So our plan is to continue the disposal process, and we expect that there will be a recovery of interest to power renewable power assets, and our target is to get the return to get offers which would be appropriate for our level of investment and our requirements for return. So at this stage, the process is continuing.
Thank you, Dimitri. And next question we've got here is what is the financial impact on the business for the future carbon capture obligations?
Future carbon credit obligations obviously is something which we will find out in the future, and because the regulatory framework hasn't been developed yet. As we mentioned in our newly issued ESG report, we have a certain amount of carbon footprint being a thermal power generating plant. Our objective is to decrease our CO2 footprint and to significantly offset our carbon emissions with our improvement in operations of power plant, consumption of less of coal consumption, and therefore emissions. But also we are targeting various ESG focused related renewable projects, growth projects, and energy transition technologies implementation, which will allow us to offset our carbon footprint, but also to reduce other emissions and to continue our superior performance in terms of water management and waste management. So at this stage, it is very difficult to say something concrete in numbers because the obligations are not formalized yet, and it remains to be seen whether there will be a unified system of carbon capturing obligations in various countries.
Thanks, Dimitri. We've had a couple of questions around dividends and also, what percentage of free cash do you expect to pay for dividends? If you could give any information on that dividend angle, that'd be great.
Before this period of unprecedented volatility and the COVID, we had our dividend policy of 33% of profit after tax, subject to free cash flow test. This year, the board decided to focus on conserving cash for repayment of debt and also withstanding this period of high commodity prices. And the board will revisit the dividend policy when situation normalizes. So depending on when the commodity market situations and obviously lifting of restrictions COVID-19 related will be eased, the board immediately will look into revisiting the dividend policy.
Thanks again, Dmitry. Another question here about looking at vertical integration, saying that there are some very cheap coal assets available. Would you look at potential acquisitions to vertically integrate in relation to coal?
Vertical integration is something which we've considered in the past, but again, given the long-term and medium-term trends and focus on greener and cleaner environment, we are not considering doing vertical integration. And we are focusing on promoting our ESG agenda, which is reducing our carbon footprint, reduction of emissions, but also implementation in the future energy transition technologies.
That's great, thank you. Question here reads as follows: with the market not recognizing the intrinsic value of the company, are there any plans for significant share buybacks?
Share buybacks are also considered by the board and by the company, something in line with our dividend revision of dividend policy. So we consider both of those ways to return to reward our shareholders. So this will be definitely revisited, those plans to either do share buyback or restating dividend policy or combination of it after situation normalizes relating to the commodity prices and COVID-19 restrictions.
That's great, thank you. I know we touched on this with the slide, but something you probably will be limited to answer. What's the fair value of the company based on your free cash flow numbers?
Based on the that was the information presented on slide 8. Effectively, you can see that we've generated free cash flows. We had cash flows from operations of 40 million in FY21, with free cash flows of just under 35 million pounds. And our net debt position at the end of March was 16.2 million versus gross debt position of 46.6 million. And our investors can clearly calculate that cash and marketable liquid securities are comprising around 30 million pounds at the end of March. And this is versus market capitalization of company around 50 million as of now. Based on the multiples presented on slide 8 for our Indian peers and our European companies, the cash flow yield is around 5%, and we have 43% average cash flow yield over the last 3 years, and 67% over based on the FY21 numbers. So you can clearly see that the market capitalization of the company is not reflecting fundamental value of the company, and we expect a re-rating happening over time. And we wouldn't be surprised to see increase 4 or 5 times in market cap when the discount reduces, from fundamental value to market capitalization. A year ago, our broker Senkers issued some detailed analysis and research, and they came up with, again, based on various comparables and industry multiples, that the share price should be around 40 pence per share plus. Our book value is actually reflecting also around 40 pence per share. So today, as of today, we are trading at around between 12 and 13 pence. I can see that fully justifiably we have 300 potential increase over time with further growth going along with our delivery of our strategies.
Thanks, Dmitry. We've got a question here as well, just a bit more of a technical question, saying, as per the cash flow statement, 25 million of cash was used to purchase investments, but only 13 million investments on the balance sheet. Could you clarify?
So we've issued non-convertible debentures in June 2020 of around 20 million pounds, which are due in June 2023. And we have also around 23 million of remaining term loans, which are scheduled over next 4 years for repayment. As part of accumulation of funds for repayment of the debentures and debt, we invested some portion of cash and classified it as restricted cash in highly liquid marketable securities, which are readily convertible to cash if required. And those investments are hitting our balance sheet as a restricted cash or as other short-term assets.
Fantastic. Dimitri, Arvin, I think you've pretty much covered off all the questions that we've had through. And of course, any further questions that do come through, you will be able to review, and we'll publish responses where appropriate to do so on the Investor Meet Company platform. Dimitri, perhaps I could just ask you for a closing snapshot as well before we redirect the attendees to give you some feedback, please.
Ladies and gentlemen, thank you for your attention and listening to our webinar today. We are very open to your ideas, suggestions, how we can continue improving our operations and our communication with all the stakeholders. And we would be happy to meet either in person or over the various online platforms. We are always available by email. And I would like again to thank everyone for attending this webinar and to wish everyone a great day and a great week. Thank you.
Dimitri, Arvin, thank you again for updating investors today. Could I please ask investors not to close this session, as you'll be automatically redirected with the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of OPG Power Ventures PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good morning.